Let's continue on with our wrap the week segment. I love Fridays because it's a great way to try to make sense of things, take a step back from the short term movements, focus on the big picture. And so, our poll question actually this week is really geared off of that long term perspective. We asked you, in your opinion, what's the probability of the S&P 500 closing above 5,000 on September 31st? 2001. And just to orient ourselves, the S&P currently around 4465 or so, we'll call it 4460. So the by far the third a third of you responded below 30%. That was the most. However, there was no clear majority here. Next after that, and not far behind, was a 50 to 70% probability, and then the next two, 30 to 50%, and then above 70%. So really, it was all over the place, but I would say skewed to the downside. The most popular answer was a below 30% probability. The reason why I asked the question that way is because I would encourage you to think about the investment landscape as a series of probabilities. I posted a video on my YouTube channel earlier this week. It's called Market Misbehavior. We talked about Tesla and four potential scenarios for Tesla over the next 6 to 8 weeks. The reason why we do it that way is because there's one most likely scenario that you can probably come up with, but then there are alternate scenarios that could play out. So is there a chance the S&P can go above 5,000 by the end of the year? Absolutely. I think it's a non-zero probability. Is there a chance the S&P goes below 3,700? There is a possibility. I would say unlikely, but it's possible. And so thinking about those probabilities of all of those different scenarios, what your portfolio might do, what a particular position might do, can make sure that you're not caught off guard. And that's the essence of that question. And I appreciate many of you suggesting unlikely. And I would agree. I would not put it in there. I'd probably put it in the 30, 50% range if I was voting there. Let's continue on with our wrap the week segment. So what we like to do is start with a chart of the major asset classes and how they've performed over the last 5 trading days. Usually we had a shortened holiday week, so we're starting it last Friday on September 3rd, skipping the holiday and then going at the 4 trading days we've seen since. What have these major asset classes done? Well, at the close here, the S&P finished the week down 1.7%. When we've called this a digestion week, think of the last couple of weeks as the big meal. This week was about digestion, and the challenge is this can quickly become indigestion if the market starts going down. And it's funny, we actually use the horrible phrase "puking up" returns if we continue to go much lower than this. Hopefully, it does not come to that, but that's what this beginning could look like. It's all about defining your risk, which we'll talk about when we look at a chart of the S&P 500 here in a few moments. A couple things underperformed the S&P this week. Gold was down 2.3%. In purple, we have small caps using the Russell 2000 down 2.8%. So small caps, the weakest of the bunch here. Everything else on the chart here outperformed. In pink, we have the NASDAQ 100 only down 1.3%. In orange, emerging markets only down 1.2%. I would keep your eye on that emerging markets to developed markets ratio. It's actually starting to favor emerging markets again here recently. Up here, we have in red TLT, which is the long bond ETF, up 0.2%. In brown, crude oil, up 0.3% using the USO. And then the US dollar, actually the best performer, up 0.6%. We talked about that strong dollar environment and what that means for US versus non-US returns. We did not have Bitcoin on here. Added on the list, and you can see why I kind of took it off. It's an outlier to the downside, down 8.5%, moving a little bit lower again today. The big movement lower was over the weekend into Friday, where it came off pretty suddenly, and most cryptos are down in a pretty decent way. Bitcoin, Ethereum, and Litecoin and others all sort of struggling this week, but overall underperforming stocks by a fairly good clip here. The remainder of our Wrap the Week segment will be devoted to the Mindful Investor Live chart list. You can get to this list, by the way, at any point. Go to the Articles tab, go to my homepage, which is called the Mindful Investor, and you'll see a button at the top to access this live chart list. It appears here at the close, given the weakness that we had, that the short-term market trend model, we review this every Friday, the short-term model has been bullish since June. Basically, it looks at the weekly close versus the 5-week exponential moving average. Gave a sell signal today, and we actually closed below the 5-week EMA just barely here going into the close. And earlier in the day, I was sending a note to my market misbehavior premium clients, did not, sort of saying it looks like we may get there, but we'd have to really distribute going into the close, which we've now done. So it's confirmed a short-term sell signal. It's only happened a couple times so far this year. Once in June when we pulled back, and then another time in February, another time in January. Each of those times indicates at the very least the beginning of some sort of pullback. And the question is how much it materializes from there. So going into next week, we'll talk here in a moment about some of the key levels to talk about. The long-term model has remained very, very positive for over a year. That is meant to capture the long-term trend That's going to remain positive until you get a significant pullback in the S&P 500. The weekly PPO, or the weekly MACD, actually turned negative in May. This is an interesting one. It's been a little frustrating to see the medium-term model be negative as S&P goes higher and higher. The way I've sort of made sense of that is it really is picking up on the internal weakness in the market. The trends are just not as strong as they were before, and you're seeing that on a lot of names that are actually breaking to new swing lows. While the S&P made a new high last week and pulling back a little bit today, a lot of stocks are well past the pullback stage into the fairly significant correction stage. You don't have to look that far. Look at some of the consumer staples, look at energy, a bunch of different sectors that you're seeing those pullbacks that are fairly meaningful, 10, 20, even 30% or more. So that medium term signal being weak or being negative has reminded me to focus more on potential risk than potential return. And it served me overall fairly well here. The daily chart of the S&P, we spent a good amount of time here in recent days dissecting this one, just because we sort of had this distribution phase so far this week, really pushing lower today. And again, let's put it in a proper context. We're still about a week after, or a little over a week after, new all-time highs. So the S&P is not far off significant all-time highs. What we've talked about recently, I think I'd repeat here today. There are three things I would look for that would tell me that the S&P is no longer in an up phase and beginning, at the very least, the beginning of some sort of down phase. And how significant that is, it will be the next set of things we'll probably talk about, given, if that would start to happen. But first thing is you need to make a lower high. We're still coming off of all-time highs, which means at some point we have another bounce higher, could be next week. And the question is, do we eclipse the previous highs? Every other time year to date, we've pulled back and then we've rotated and made new all-time highs. At some point that breaks, and that tells you that things are starting to be a little more concerning. Last time that really happened, I would argue back here in May, is where we undercut the April low. And that's when we started to think a little bit more about downside protection. As you know, the market didn't really, the downtrend didn't really materialize. We reverted higher soon after. The second thing would be a break below the 50-day moving average. This has been the line in the sand, and I've been focusing on it. Many other strategists have certainly been talking about it, and that's why, to me, it tells me that it's a fairly widely followed indicator. And while that's encouraging, because if we hit the 50-day, I would expect at the very least to bounce higher because so many people are expecting that. But what happens when it doesn't hold? That's when I think you could see a flood to the exits as we realize the 50-day is no longer the floor in the market. We see that stocks can actually go lower. We start to see gains or losses materialize on individual stock charts. That's when things can get a lot lower, a lot more quickly. The final trigger, I would say, would be a break below the most recent swing low here in August, which is around 43.60. We break all of those, or we confirm all of those three things: a lower high, a lower low, and a break of the 50-day. You will hear my voice become a lot less encouraging and optimistic, and much more, encouraging you to think defensively and think about cash versus risk assets, and think more risk off. We're not there yet. Breadth measures overall, not quite updated for today. These are going to come off a little bit, but overall, I think at the best, I mean, at the least, they're neutral, if not positive. I think the S&P cumulative advanced decline line still in a trend of higher highs and higher lows. The NYSE and the mid-cap AD lines have both recently made new all-time highs or new swing highs. We've not seen that in the small cap breadth. So if we would sell off from here, the small cap AD line will become the new indicator that you're probably going to want to follow, because it's the only one that has not confirmed this uptrend. It's been, in the last couple of months, rotating more to the downside. This breadth reading, I think, is an important one to pay attention to. This is the percent of stocks above their 200-day moving average. We've talked about this earlier in the week, and I think paying attention to this level where we're at. We're now currently at the lowest level that we've been year to date. The last time we were this low was back in November. So, we're making new swing lows. And again, not updated for today. This is going to come off a little bit more, most likely, given the weakness we saw today. But keep that in mind. That still means 3 out of 4 S&P stocks are remaining above their 200-day moving average, but we are not confirming these recent highs. So July, August, new highs, and even in early September, this has been trending lower, which tells you plenty of stocks are not just breaking down through their 50-day, they're breaking down through the longer-term smoothing mechanism.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.